Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, Client Advisor at Providend. In today's episode, we will discuss on the topic of business exit planning. More specifically, we'll be looking at how to value your business, strategies to increase your sales price, and how to find the right buyer. Joining us today is Jerome Song, Associate Director of Business Exit at Providend. Hi Jerome.
Hi Isaac.
Yeah, so Jerome is an experienced business advisor with many years of corporate management and advisory experience. He assists business owners with vision alignment, team development, organizational transformation, business valuation, and exit strategies. Okay, Jerome, so let's just dive right into today's topic, right? So on a high level, could you explain what business exit is?
Yes, so business exit is often confused to be just selling business. Exit is definitely more than just a selling of business. It can involve the internal exits and external exits. What do I mean by internal exit? This refers to the transitions within the company or stakeholders. Now, this could be in the form of a management buyout, where the management buys over the company from the owners, or it could be in the form of a succession planning, where we pass the company to the chosen successors. For external exit, this looks at transitions outside of the company. It could be in the form of a strategic sale, where we could be selling to your competitors, or it could be selling to a private equity. So it could be in the form of orderly liquidations. Now, understanding these options helps us tailor the exit strategy, to meet specific goals, whether is it maximizing of value or ensuring continuity or exploring new growth opportunities. And at Providend, we use this value acceleration methodology, which was developed by the Exit Planning Institute in the US, where we take a comprehensive approach to enhancing the value of a business and preparing it for a successful transition, such as a sale or transfer of ownership.
Okay, so Jerome, just now you mentioned the value acceleration methodology. So could you elaborate what this methodology is and what the process looks like?
The value acceleration methodology is a structured and proven process where we focus on the value growth and aligning their business, personal and financial goals. Now, the value acceleration methodology involves 3 gates, and these 3 gates are discover, prepare, and decide. Now, the first of the 3 gates in the value acceleration methodology is the discover gate, and this involves 3 components. They are the business valuation, assessment of the owner and business readiness and attractiveness, and the creation of a prioritized action plan. Now, the first step of this value acceleration methodology, or we call it VAM for short, is to have that baseline of measurement of business value. Now, this is what we call the triggering event, where we have it for business planning and tax and estate planning, and also their personal planning, right? A thorough assessment of this business current state, where they are in terms of the market position, their financial health, operational efficiencies, and growth efficiencies and prospects are what we do when we assess the business readiness and attractiveness. All right, so well-advised business owners rely on the facts that a formal business valuation produces, rather than relying on hearsay and comparing their business to others. Now, based on this assessment, a strategic plan is developed to address areas where improvements can be made to enhance the value of the business. But everything should always start from knowing their business value.
Right, so once they know their business value, then only then they can go into the next stage, which is preparation.
That's right, and that's where you move into the second gate, and that's the prepare gate. Now, there are these three steps that you need to take. First is the developing of an action plan. Now, this is where we create a detailed plan to address these areas that we have discovered in the discover phase. This includes strategies for growth, cost reduction, and operational improvements. And then we move on to implementing these improvements by executing the action plan, focusing on enhancing of the value drivers. Now, this might involve streamlining of the operations, improving financial performance, and strengthening of management. Now, after doing all this, then we also need to constantly monitor the progress by regularly reviewing the progress of these improvements and adjusting the strategies needed to ensure that we are on track to meet these goals.
Right. So that's for the preparation part. And then after that, by knowing all of this, right, then it's easier for the business owner, or rather, when they have to make the decision of whether to sell the business, at least everything is a lot clearer. And, all the things are put in place for it to happen already.
That's right. And that's where we move into the decide gate, the final stage, where they assess their various options, evaluate all these options, such as selling the company or passing on to family members, or could be merging with another company, and choosing the best path and deciding on the best exit strategies based on their goals, the market conditions, and the improved state of their business. And then finally, to execute the exit, this is where you carry out the exit strategy, ensuring a smooth transition and maximizing the value received from the business exit. Now, in summary, this VAM involves discovering the current values and areas for improvement, preparing the business to enhance its value, and deciding on the best strategy to achieve these goals.
Right. Thanks for providing such a detailed explanation of what the value acceleration methodology is. I understand it's to describe the whole process even on a high level is quite difficult because it's a very thorough process. But I think for our listeners, let's just unpack what these gates are. I mean specifically for Discover, right? So let's start with Discover. So why is it important for SME owners to get a business valuation?
Well, according to the Exit Planning Institute, 70 to 80% of the businesses that is put up for sale doesn't actually get sold. And this high percentage highlights the importance of proper exit planning and challenges that business owners face when they are trying to sell the business. A professional valuation is crucial because it provides a baseline for negotiation and helps to set realistic expectations for the business owners. Because without a proper valuation, owners might overvalue it or underestimate their business worth, which can lead to missed opportunities or undervalued deals. Let me share an example with you. There was a case where the business owners of a light footwear manufacturing company was struggling for a while. A potential buyer came along and approached the business owners with an offer. And the amount was lower than what they had hoped for. They didn't do a valuation. They were unsure of what this business was worth, and they relied on their own estimates and emotional attachment. And months later, the business financial situation deteriorated for this company. They sought advice and finally did a professional valuation. And what they have found was that actually the initial offer from the potential buyers was fair and just slightly below the market value given the business declining performance. Now, on hindsight, the business owners realized that the importance of having a proper business valuation, which would have given them a realistic understanding of their business worth, and with that, it could help them capitalize on this opportunity and secure them that financial stability and relieve them of the stress of running a business that is unprofitable.
Right. So the example you gave is that there was an offer that came in. It was the business owners were thinking, hey, this is why you lowballing me, right?
That's right. That's right.
But it turns out that actually it was quite close. I mean, perhaps maybe just slightly under fair value, and perhaps maybe if they had sought advice earlier, right? They might have accepted the offer and saved themselves from having to go through such a tough situation.
That's right.
Okay, so Jerome, so how then is valuation done, right? So you mentioned that, okay, it's important for them to get the valuation. So how is it done, and what factors typically influence a business valuation?
Sure. Well, when it comes to valuing small and medium businesses, there are three primary methods that are commonly used. The income approach method, the asset-based approach method, and the market approach method. Now, one of the most common used techniques in the income approach is the discounted cash flow approach, where the future cash flows are discounted back to their present value using a discount rate that reflects the risk of this cash flow. That's the first method. The second method would be the asset-based method, where you value a business based on the value of its assets minus of its liabilities. Now, these are often used for companies that have substantial tangible assets. Real estate is one of them, or in liquidation scenarios. Finally, the market approach, this commonly used method values a business based on how similar businesses are being valued in the market. It relies on comparing the company to other similar companies that have been sold recently. Now, this involves first identifying, similar businesses in your industry that have been sold recently. Two is determining these multiples and calculating these valuation multiples. We have a software to do that. And third is to apply the multiples to your business financial metrics, whether it's sales or EBITDA, two of the commonly used ones. Let me give you an example. Let's say, for example, your business can be similar businesses have been sold for 5 times their annual earnings. And if your business is earning like 200,000 a year, if we apply the 5 multiples to these earnings, then probably your business could be worth around $1 million or so. It's really quite simple math if you think about it, because on one hand, it's about increasing your cash flow, whether it's sales or EBITDA, and this could be working on a combination of strategies aimed at boosting revenue, from revenue growth strategies such as your expansion of market, new product or services, and cost management. And that's where you look at expense control, operational efficiency, and supply chain optimization. And then on the right side is the multiple, that is the number assigned by the private capital market to the value of your tangible and intangible assets and the risk associated with your business. So value acceleration is achieved by focusing on the multiple, which is largely based on the strength of your intangible assets. Now, however, industry standards or multiples don't really reflect the true value of your business, as these are intangible assets that are not captured in the financial statements. We have to understand that the industry averages provide a general guideline, but that they may not capture the unique value of your business, of a specific business. Many valuable intangible assets, such as the brand strength, the customer loyalty, and proprietary technology, are not fully reflected in these financial statements and may not adequately be captured in the generic industry multiples.
Hi listener, we hope you're enjoying this episode and podcast series so far. At Providend, we have been sharing our thought leadership content through various mediums beyond just this podcast. If you're interested in knowing more, check out the link in the show note to subscribe to our newsletter today. Thank you, and let's get back to the episode. Right, so getting a valuation is not so straightforward, right? Just getting the EBITDA times multiple. So we want to make sure that the valuation captures all these intangible stuffs as well.
That's right.
Okay, so the next gate that you mentioned is the called prepare, right? Yeah. So which is about how the business owner can potentially increase the sale price of his or her business. So what are some strategies that SME owners use to enhance the value of their business prior to selling?
There are several strategies that business owners can use. First is to improve their financial performance by increasing sales and cutting unnecessary expense to make the business more attractive. This will improve the sales and the EBITDA. All right. Secondly, ensuring that the business has a solid management team, because this can reassure buyers that the business can continue running smoothly post-sale. The business is most valuable when it's not owner dependent. We talk to a lot of business owners, and a lot of business owners always complain that they cannot go on holiday because they are tied to the businesses. And that's where we also need to understand, what are these intangible assets that we mentioned earlier that is driving the value of your business. This is the third thing that the business owners need to do, because intangible assets are knowledge, capitals that can be divided into these 4 areas. We call it the 4 C's, the 4 capital, and these are human, customer, structural, and social capital. Let me start off with the first of the 4, human. Human capital, this refers to the value of your talent. It's a measure of the talent of your team, and if you have a strong talent, then someone will put a value to that. And strategies to enhance this could be in the form of competency development, succession planning, leadership development, strengthening of team dynamics. Second is the customer capital. This is about the value of your customer relationships. Now, a business with a recurring revenue and low risk of customer concentrations would be of a higher value. For example, if a business have a strong, loyal customer base with consistent revenue, this will definitely have a higher valuation than one with fluctuating profits and limited market presence. So by diversifying the customer base, it can reduce the dependency on a few major clients or customers, which can be a risk factor for buyers. Third would be structural, and this is about the value of your systems and the intellectual property. This comprises of the system and tools that augment the customer and human capital that we talked about earlier, on which the company is built. Now, questions buyers would look for, will ask is, are there specific processes, people, technology, and facilities that they can deploy that makes them special? Is this well documented to the point that they are transferable and someone willing to pay a premium to get them? Yeah. Formalizing these processes and documents can demonstrate that the business is well organized and ready for a seamless transition. And finally, the last capital, social capital, is the value of your brand and culture. And this represents the culture, the brand, the way the team works, the rhythm of the day-to-day operations and communications, and the way you communicate with customers. So to increase the value of your business, we will need to work on these 4 C's. All right. It's important to understand that the value can only be harvested if the intellectual capital is transferable. If someone sees a value in it, so the only way to cash in on this most valuable asset is to transfer it to someone who is willing to pay you a premium, because they have not been able to duplicate, or they don't want to spend years to get to where you are today. And it's a lot easier to scale a business by leveraging on a successful business model.
Right. So we want to find out, of course, what's the valuation first, right? You find out the valuation, then we improve the business.
That's right.
Right. And to improve the business, we look at the 4 C's, right?
That's right.
So that is the social, structural, customer, and what's the last one? Human. Yeah, human capital, right? So by looking at the 4 C's, then you can see how you can improve these, and then you can say, okay, so this is the starting base valuation. We do this preparation work, and then we can see if this helps improve the valuation. Right. And that leads on to the next step, right, which is the third gate, which is to decide. And really beyond the quantitative factors, I think that you have mentioned so extensively earlier in this podcast, why is it important for the buyer to, or rather the seller, to find a buyer who aligns with the owner's vision for the business?
Let me share my thoughts on this. Finding a right buyer is essential because it ensures the continuity of a business and the welfare of its employees. This is something that a lot of business owners that we talk to is very concerned. Now, owners often want to see their legacy preserved and their employees being taken care of. A buyer who shares the same vision and values can continue the business culture and reputation, which is important to the selling owner.
Right. So at this point, it's all about, okay, so once they find a buyer that shares the vision or rather have the same values, then they'll make a decision whether to execute or actually after doing all this improvement, they may choose to continue running the business, right?
That's right. Yeah.
So after accounting for the quantitative factors, the qualitative factors, of course, whether the buyer shares the same values as the business owner, the decision has to be made, right, to sell the business. And they could choose to keep the business after doing all this, after improving the 4 C's like you mentioned. So Jerome, could you give us an example of a business that successfully implemented these strategies?
The sale of 18 Chefs, I'm not sure whether
18
18 Chefs, the casual dining chain in Singapore, provides an interesting study of how business owners prepared their business for sale. Now, 18 Chefs was founded by Benny Se Teo. He's a former drug addict who turned his life around and started this restaurant chain to help at-risk youths or ex-convicts by providing them with employment opportunities. The business was eventually sold to Commonwealth Capital, a private equity firm that focuses on F&B businesses. Now, this sale exemplifies how a well-prepared business can attract high-value acquisition offers. By focusing on a strong brand with a unique value proposition, helping at-risk youths and providing employment opportunities for ex-convicts, and ensuring financial transparency, optimizing operations, developing a competent management team, and engaging professional advisors. Benny successfully positioned 18 Chefs for a profitable and smooth transition to the new leadership. Now, in 18 Chefs' case, it is known for its mission to provide employment opportunities to the ex-offenders and at-risk youths. The founder, Benny, would like to ensure that the buyer is aligned with his values and commitment to social responsibility.
Right, thanks for sharing, Jerome. So, from your example, we can see that having a proper business exit strategy is really crucial, right? However, can you think of any scenarios whereby it may not be necessary to engage a business exit advisor?
Yeah, there are indeed scenarios where engaging a business exit might not be strictly necessary. However, it's essential to understand that these scenarios are exceptions rather than norm. There are a few situations where business owners may not need an exit advisor. For example, early stage businesses. If a business is in its early stages, the owner is very focused on growing the business, establishing the business rather than planning for an exit. The need for an exit advisor may not be immediate at this point in time because the primary focus should be on growth, stability, and establishing market presence. However, when starting a business, we should always have an end in mind, including exit planning. This is a strategic approach that offers numerous benefits and ensures a long-term success. It helps to encourage strategic thinking and planning, which are crucial for sustainable growth and success. By doing so, it helps the business owner to focus on enhancing these factors that we talked about earlier that will drive business value, such as increasing your revenue, improving your profitability, and building a strong management team.
Okay, so to wrap up, we have discussed quite a lot today. So if there's one key takeaway that you'd like SME owners to remember, right, when they're thinking about exiting their business, what do you think that would be?
Planning ahead. It's never too early to start, so plan ahead and take time to prepare your business for the sale. Understanding where the business value, how you enhance that value, and finding the right buyer, thinking about the right buyer can significantly enhance the chances of a successful exit.
Okay, that's all the time we have today. Thank you so much for your time and insights today, Jerome. It's been a pleasure having you on.
Thank you for inviting me.
Yeah, so to all our listeners, I hope you enjoyed our episode on business exit planning. So if you like this episode, please follow and subscribe to our podcast if you have not done so already. As always, thank you for tuning in, and I'll see you all in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.